SpaceX went public in June. The stock slumped. And according to trading data, mom-and-pop investors have bought it on net every single trading day since the IPO. Not most days, every day. The stock goes down, they buy. The stock goes sideways, they buy. There has not been a single session where retail investors, as a group, were net sellers. That is a remarkable pattern, and it tells you something important about how modern markets actually work. Today I want to walk through what's happening, what an IPO really is underneath the headlines, and the specific mechanics that explain why a stock can fall right after the most hyped listing in years. Quick note before we start, nothing here is financial advice. I'm not a financial advisor, and I'm not telling you to buy or sell anything. This is an explanation of mechanics, so you can think about it yourself. Let's start with what an IPO actually is, because the popular understanding is wrong in a way that matters. An initial public offering is not primarily about raising money for the future. It's about creating a market where none existed. Before an IPO, a private company's shares are almost impossible to sell. Early employees hold stock they cannot convert into cash. Venture investors have paper gains they cannot realize. The company might be worth an enormous amount on paper, and none of that value is accessible to the people holding it. An IPO fixes that. It creates a public market, which means those shares can now be sold to anyone with a brokerage account. Which brings us to the mechanic that explains most post-IPO price behavior, and almost nobody outside finance knows about it. It's called the lockup period. When a company goes public, insiders, meaning employees, executives, and early investors, are typically contractually prohibited from selling their shares for a set period after the listing, commonly around 90 to 180 days. The reason is straightforward. If everyone who held shares before the IPO could dump them on day one, the flood of supply would crush the price immediately. The lockup prevents that. But notice what it creates. For those first few months, the number of shares actually available to trade, what's called the float, is artificially small. Demand from new buyers is chasing a limited supply. And then the lockup expires. Suddenly, a much larger pool of shares becomes sellable, held by people who, in many cases, have been waiting years to convert paper wealth into actual money. Anyone who has followed high-profile listings knows what tends to happen around that date. It doesn't always play out the same way, and it's widely anticipated, so markets price some of it in. But it's a real, scheduled supply event, and it's one of the reasons that the price in the first months after an IPO is not a clean read on what a company is worth. Now, the second mechanic, IPO pricing itself.
The offering price is negotiated between the company and its underwriting banks. Those banks allocate shares to institutional clients before trading begins. Which means there are two very different entry points. Institutions who received an allocation at the offering price, and everyone else who buys on the open market at whatever the price happens to be when trading starts. If a stock opens sharply above its offering price, the institutions that got allocations are immediately sitting on gains. Retail buyers on the first day are buying from a completely different cost basis. That gap isn't a scandal, it's how the process is structured. But it explains a lot about why the IPO went great and people who bought it lost money can both be true at the same time. So now, let's look at the retail behavior, because that's the actually interesting part. Buying every day, regardless of price direction, describes a specific approach. It isn't trading. Traders react to price. This is accumulation, which means buying steadily on a schedule based on conviction about the long term. There are reasonable arguments behind that, and reasonable arguments against. In favor, for a company someone believes in over a 10 or 20-year horizon, the price in month 2 is genuinely irrelevant. Buying consistently, regardless of price, sometimes called dollar cost averaging, removes the impossible task of timing entries. And a falling price simply means the same money buys more shares. Against, and this deserves equal weight. Consistent accumulation only works if the underlying belief is correct.
The strategy protects you from bad timing. It does not protect you from being wrong about the company. If a business underperforms for a decade, buying it steadily the whole way down means you bought a lot of something that didn't work. And there's a psychological trap worth naming. There's a real difference between conviction and commitment. Conviction means you'd buy it today at today's price based on today's information. Commitment means you keep buying because you already own it, and stopping would mean admitting the earlier purchases were a mistake. Those feel identical from the inside. They are completely different things. Now, the broader context this sits in, because SpaceX is not happening in isolation. This has been a strange stretch in markets. The Dow closed at a record high in the first days of August. Amazon crossed $3 trillion in market value for the first time. And in the same week, Jeff Bezos filed to sell around $4 billion worth of Amazon shares. That last detail is worth understanding rather than reacting to. Large insider sales are routine, frequently pre-scheduled through automated plans set up months in advance, specifically so they can't be read as market timing. It is not automatically a signal about the company. Founders diversify, pay taxes, and fund other ventures. Meanwhile, the broader picture involves European equities hitting records, Asian markets falling on semiconductor weakness, oil moving with every development in the Middle East, and everyone waiting on labor market data to guess at the Federal Reserve's next move on rates, currently sitting in the 3.5% to 3.75% range. Which is to say, there is no single story in the market right now. There are several, and they're pulling in different directions. So what's the actual takeaway from all this? 3 things, and none of them are instructions. First, price movement in the months after an IPO is heavily influenced by mechanics, specifically lockups and float, not just by what people think a company is worth. Reading the early chart as a verdict on the business is a mistake in both directions. Second, the entry point matters enormously, and it's rarely visible. Institutional allocations, retail open market purchases, and insider cost bases are all completely different, and the same headline number means something different to each group. And third, the most useful question you can ask about any position, including one you already hold, is the conviction question. Would I buy this today, at today's price, knowing what I know now? If the honest answer is no, then continuing to add is not a strategy, it's inertia. The retail investors buying SpaceX every day may turn out to be exactly right. It's a company with genuine achievements behind it and enormous ambitions ahead of it. They may also turn out to be early on a stock that takes a decade to justify its listing price. Nobody knows which, including everyone confidently telling you they do. What you can know is the machinery, which is what I've tried to give you here. Not financial advice, just the mechanics. If this was useful, the next episode goes into lockup expirations specifically. What actually happens on that date and how to see it coming. That video's on your screen right now, and the full series is linked in the description below. Subscribe to Money Matrix Kingdom for finance explained without the hype every week. And tell me in the comments, have you ever bought into an IPO, and how did it go? Honest answers, wins, and losses. See you in the next one.